Hello guys, welcome back. Now we are going to continue with question number 4, part A, which says, okay, let's start. AB Limited produces a single product V2 and sells it at a fixed price of 2050 per unit. What is the price? Okay. Yeah, what is the price? 2050 per unit. The production and sales data for the first quarter. Okay, first quarter April, May, June. So the information for the first quarter has been given, like sales and production in units have they have given. So if production is done for 4600 units and sales only 4200 has been done, then what is left? 400 units are left. If there is no opening stock, then entire 4000 units are closing stock or not. So I don't know whether the opening stock. Okay, so there was no opening stock, opening inventory at the start of the quarter, it seems, which means for the March there is no opening. I mean, like at the end of the March there is no closing stock, so that's why there is no opening stock for the month of April. So if there is no opening stock at all, then the entire 400 units is closing stock for April or not? Yes, yeah. So the 400 units, if it is closing stock for April, then opening stock for May, what is opening stock for May? It's 400 because it's closing stock for April and opening stock for May. So opening stock, so that's how you calculate. Okay, and have given sales and production. You have opening stock by by taking closing stock from April. Now you have to calculate closing stock for May, and again after calculating closing stock for May, that is the opening stock for June. And they have given sales and production in units, so that's how you calculate closing stock for June. Okay, now they have given some information. Actual or budget information for the each month was as follows. Okay, direct materials, direct labor, and these are all variable costs only. Okay, variable production overheads, they have given some information. And this variable production overheads is 150% of direct labor. So we need to calculate first this direct labor, and then we can get variable production overheads. Now here, listen carefully, this is really important. See, fixed production overheads, they have given 5 lakh. Okay, so in variable there is a nature of variable cost and fixed cost. In variable cost, per unit it is fixed, but when it comes to total, it is changed, right? Variable per unit is fixed, but fixed cost overall and in entirety it is fixed, but per unit fixed cost changes, right? This is this is the nature. Okay, variable cost in total is same, but per unit, I mean, sorry, variable cost in total changes because as per unit it changes. No, per unit it is the same. Per unit, for example, variable cost is 100. If you sold 10,000 units, 12,000 units, as per the units it changes. In total it differs. Okay, it varies, but per unit it is the same, like constant, fixed. So here fixed production cost 5 lakh means per unit we want. Here we don't take this 5 lakhs, but see here, fixed production overheads are budgeted at 60 lakh per annum and are absorbed into products based on normal output of 60,000 units per annum. So for unit, if while calculating the cost, these are all like, direct materials, labor, variable, all this we need for calculating the cost only, so for calculating cost we need per unit, right? So we cannot take this 5 lakhs and divide it with number of units, and do not do that. We only come with this budgeted thing only, the 60 lakh per annum divided by 60,000 units. So per unit you get only standard one or budgeted one. You have to take this one only into consideration for calculating per unit. This is the standard one. And if here it is the 5 lakh, here 5 lakhs is there, no ma'am, how can we take? You take this, and there is any adjustment, if there is any adjustment, we'll do that adjustment by under our over absorption. We'll definitely do the adjustment because here it is not in common, like, there is something contrary, right? So 100 per unit only you'll take. There is there is definitely some difference. So that will adjust by doing under or over absorption. I mean under or over absorption. Yeah. So now, and yeah, fixed selling overheads, this does not come in cost, because selling overheads are after production and all. So that will lastly add 95,000. And what is required? Prepare a profit statement for each of the 3 months using absorption costing principle, and the same profit statement using marginal costing principles, and prepare a reconciliation statement. Obviously, using if we use by absorption costing principles, and if we use a marginal costing principle, the profit will be same or different. Obviously there will be some difference because the methods are changed. So he wants to prepare a reconciliation statement of profit and loss, because the methods, two methods are there, no, so we get different answers, so he wants reconciliation. So yeah, question clarity is there, no? So now let's go to the answer. First of all, what he needs. Okay, just a minute. Yeah, profit statement using absorption costing principles, right? Yeah, so statement of profit. Yeah, statement of profit under absorption costing for first quarter, right? So April, May and June. Now tell me, how do we get profit? Sales minus cost of goods sold, right? So sales units 4,200, 4,500, 5,200, they only given the information where it is. Yeah, sales 4,200, 4,500 and 5,200. And what is the selling price per unit? While reading the question, I told you that the fixed selling price is 2050 per unit, right? So if we multiply this, you get this sales value. These are sales for the quarter. Okay, now if we subtract the cost of goods sold from sales, we get the profit, right? Here it is. Yeah, here is the profit after subtracting this sales value from cost of goods sold. How will we get cost of goods sold? Sales plus closing stock minus opening stock. Sorry. Yeah, if we do sales plus closing minus opening and production, then comes profit. So what is cost of goods sold? Opening plus production minus closing. Simple. You can generate formulas from here and there. Okay, so cost of goods sold is nothing but opening plus production minus closing stock. Okay, so here he has put in the brackets, no, that's called we do less, that means subtracting. Okay, so cost of goods sold, opening stock. How is this 1480 is calculated? There is working notes here. Let's see, calculation of full production cost. What is this? So we are going to calculate per unit. So how is this calculated? See here, direct materials 4 kgs at 120 per kg. So 4 kg into 120, 480, and direct labor 6 hours at the rate 60. They have given in the question. See here, 6 hours at the rate 60 per hour, which comes to 360. So where is it? So yeah, 360 rupees. And variable production overhead cost, he says 150 percentage of direct labor. What is direct labor? 360 rupees. So 150 percentage of 360, which comes to 540. And now we add direct material, direct labor and variable production overheads to arrive at total variable cost. What is total variable cost? 480 plus 360 plus 540, which comes to 1380, right? So now we are calculating fixed production overhead. Okay, here fixed production overhead, in the question they have given 5 lakh. Okay, but we need per unit or total. Per unit we require, right? So I already told you, per unit fixed cost changes, and in variable fixed cost is same. But what we need to consider in order to arrive at per unit cost? We are calculating here per unit only, no? Per unit, how much is the cost? That only that's what we are that's what we require, right? So in order to arrive at per unit, if it fluctuates, then how can we calculate, how can we take fixed cost? So for that purpose only, you have to take standard one or budgeted one. For 60 lakh 60 lakh budgeted production overheads, 60,000 units are there, right? So what is per unit? 100 rupees, right? So we in order to calculate cost per unit while doing fixed cost, we need to take the budgeted one or standard one. Okay, so here fixed cost comes to 100. They have given 5 lakh, no? So there is some contrary, right? So for this we need to adjust something called under or over absorption. First, I'll just explain it after few minutes, but let's just finish it off, okay? Yeah. So fixed production overhead 60 lakh for total production overhead for 60,000 units. So per unit we are going to get 100 rupees, right? So total amount we got, like total variable cost and fixed cost, just now we have calculated, total comes to 1480 per unit, cost per unit, right? That's what we are discussing, okay? So here it is. So opening stock, there is no opening stock for April, as we discussed. He has given in the question that there is no opening inventory. Here it is. Yeah. So there was no opening inventory at the start of the quarter, right? So here there is no opening inventory, that's why. And production cost, how many units are produced? It is given in the question. Where is it? So yeah, for April, what is the production in units? 4600. If we multiply with 1480, we get 68 lakh 8000. And closing stock, how many units of closing stock? I already told you, 4600 minus 4200, which comes to 400, which is 400 units at the rate 1480, which comes to 5 lakh 92, which we have to subtract, okay? Opening plus production minus closing, right? So we have to deduct it. So this, there is something called under or over absorption. Now it's time to explain it, but before we are going to see the basic calculation of closing stock. So working notes, one you understood, no? Now let's see how the calculation of opening and closing stock is done. So opening stock for April is 0, and what is production? They have given 4600, 4400 and 5500. Sales also they have given, okay? So opening plus production minus sales is nothing but closing stock, right? So in that way we are going to find out what is closing stock. Opening plus production minus sales is closing stock, right? You don't know. So there is no opening, so directly subtract production, directly subtract the sales units from production, so we get closing stock as 400. Closing stock of April will be the opening stock of May, and opening plus production minus sales we get 300, and these 300 will go there, and this is the opening stock of June, and 300 plus 5500 minus 5200, which comes to 600, is closing stocks. So working notes 2 also over. So we have calculated opening and closing stocks. So using these units we have to multiply it with 1480, which is, cost per unit, okay? We are going to multiply this, and we are going to calculate the cost of goods sold in the above table. But before that, here is the important thing, which is under or over absorption. We have taken 100 rupees per unit, no? But he has given fixed production overheads as 5 lakh, okay? So here some contrary happens, some difference is there, so we have to adjust that, because we have taken 100 per unit by using standard thing, okay? Standard or absorbed, budgeted overheads only we have taken. So there is some difference. In order to adjust that, we have to do under or over absorption. See here, for April and May on June also, they have given 5 lakhs as fixed production overheads, right? So fixed is always fixed, 5 lakh 5 lakh 5 lakh, right? So for April, how many units are produced? 4600 and 4400 for May, 5500 for June, right? So 4600, 4400 and 5500. So these units are produced. These are the production overheads only, no? So production units only we have to take. So 4600, 4400 and 5500. And what is the production overhead per unit? We have calculated, no? 100. So into 100 into 100 into 100, right? So 4600, 4400 and 5 lakh 50,000, sorry, 4 lakh 60,000, 4 lakh 40,000 and 5 lakh 50,000, right? So actual overheads that needs to be absorbed is 5 lakh, but how much we have absorbed in April? 4 lakh 60 only. Then 40,000 is under or over absorption? Under absorption only. You have to actually absorb 5 lakh, but you have absorbed what? 4 lakh 60. 40,000 is under absorption. In May, what is the actual overhead you need to absorb? 5 lakh they have given, no. 5 lakh production overhead, production fixed overhead they have given us to 5 lakh, but we have absorbed only 4 lakh 40. So 60,000 is under absorption. In June they have given to absorb 5 lakh production overheads, but we have absorbed 5 lakh 50,000 as production overheads. 50,000 we have over absorbed. So this we need to adjust in the profit statement. We need to show this. Okay. So don't ask me about this opening and closing stock. I have explained in working notes. So 400, 300, how we got this opening and closing stock. Now we go back to the table. See here, opening, production, closing, we know production they have given, we have to just multiply with 1480 rupees, because we have done no that per unit we have done all the direct material, direct labor. Here we have, see, here we have done no. So yeah, all this. So opening plus closing, sorry, opening plus production minus closing comes to, after adjusting, this is also really important. Just now explain, no. So under or over absorption, that also we need to take. So if it is under absorption, you please add it, and if it is over absorption, you need to deduct it. After doing all this, there is something called, in fixed production, after fixed production overheads, there is something called fixed selling overhead. I told you that it doesn't come in cost, but after production, right? So here you also need to add fixed selling overhead, that is common for all the quarters, I mean all the months. So 95, 95, 95. This comes the, if we do all the calculation, then comes the cost of sales. Okay. So if we deduct the cost of sales from the sales value, you will get the profit, right? So these are the profits for month of April, May and June, right? You understood, no? Now working notes 1, 2, 3 over. Now what is the first required, guys? Profit statement using absorption costing principles, right? So we have done the project, sorry, so where is it? Yeah. So we have calculated the profit using absorption costing principles. This is the profit. Okay. So we have got the profit under absorption costing principles. Now what he have asked, marginal costing, profit statement for each of the 3 months using marginal costing principles, right? So here, statement of profit under marginal costing, right? So for the quarter of April, May, June, what is the difference between marginal and absorption costing principle? That is the statement. You prepare a cost statement, which is a sales minus variable cost. Here comes the contribution, and contribution minus fixed cost, you get the profit, right? So the the way of presentation and the way of calculation. Calculation in the sense, you have to take sales minus variable and all. But here what we have done in absorption costing, we have done sales minus cost of goods sold, right? So here we are going to separate it like here. Where is it? Yeah. So here we are going to take sales units. Sales units they have given 4,000, 4,200, 4,500 and 5,200. And selling price per unit we know which is fixed, 2,050, 2,050 and 2,050. They have given fixed price, that is selling price. So if we multiply the units with per unit, we get the sales value, which is for the April, May and June. These are the values, and we are going to subtract variable cost at the rate 1380. Why 1380? I think it's here only. Yeah, why 1380? Because total variable cost is 1380, not 1480. This 1480 is including the fixed production overheads. Okay, so we are going to only take the variable cost, which is 1380. So variable cost 1380, no, so we will multiply with the sales units, 4200 into 1380, which comes to this total. And the same with May and June also. Okay, now this is the contribution. After subtracting the sales minus variable cost, we get the contribution, no? So this is the contribution, and we have to reduce the fixed production overhead cost. There are two kinds of fixed production overhead cost, which is what are those those two fixed costs? Fixed production overheads and fixed selling overheads. Okay, here no need to take and all per unit and all, we don't need to do that. So 5 lakh for all the 3 months and 95,000 for all the 3 months, we get the profit of this 22 lakh 19,000 for April, and 24 lakh 20,000 for May, and 28 lakh 89,000 for June. Okay, but is the profit same for the absorption costing and marginal costing? No, here the numericals are different. Here the profit is different, right? You see this? Why is the profit different? Because of the different two methods, and methodology is different, no? So we get the different profit. So that's why he have asked. See here, required. So required number 1 2 we got over, right? Required number 3, what is he asking? Reconciliation of the profit or loss. Why reconciliation is needed? Because there is a difference. There are many numerous reasons for which why this difference exists. Okay, so you do the same with the reconciliation of statements, no, in foundation. Yeah, with the same also. Here also it's same. So reconciliation of profit under absorption costing to marginal costing, right? So here if you see this, for April, May and June, how we are going to reconcile it? We are going to take any one of the profit from either absorption costing or marginal costing. So here he is taking profit under absorption costing. And what is the reason for the difference? Here we have not considered any opening or closing stocks here in under marginal costing. See, we have only taken sales minus variable minus fixed cost, right? So we have arrived at the profit. But here what we have done in absorption costing, we have considered opening and closing stocks, right? So here, where is it? Yeah, here we are going to take this profit. See, remember, try to recollect the trading account. In trading account, opening plus profit minus closing only, no, we do. So profit plus opening minus closing. So we get the profit under marginal costing. That only he have done. Okay, see, profit under absorption costing plus opening stock he have done and minus closing he have done. So if you reconcile this, if you add and less this, we get the profit under marginal costing. That's it. Let's check it out. Okay, profit under absorption costing. You see the table and copy the same profits under absorption costing. These are the values. Okay, now is there any opening stock for April? No, so 0. Okay, now the closing stock is 40,000. We have calculated above. So from the above figures only I'm taking. So 40,000. So if we deduct this 40,000 from this to 22 lakh 59,000, it comes to 22 lakh 19,000. And for the May, it's the same. 24 lakh 10,000 is the profit under absorption costing, and opening stock is 40,000, and closing stock is 30,000. Okay, these are the above figures only. So if we add and deduct the opening and closing stock, we get the profit of 24 lakh 20,000. And same with the June also. 29 lakh 19,000 is the profit under absorption costing. We add the opening stock and we deduct the closing stock. We get the profit of 28 lakh 89,000. So these are the profit we got. Let's check these are the same with the marginal costing profit or not. Okay, 22 lakh 19, 24 lakh 20 and 28 lakh 89, right? So here are the same figures. 22 lakh 19, 24 lakh 20, 28 lakh 89,000 is the same. So if we do these adjustments like add the opening stock and deduct the closing stock, we get the profit under marginal cost. So it is reconciled. No, now everything is perfect, right? So this is the reconciliation statement done with all the 3 requirements. Okay guys, now let's quickly come into the question number 4 part B. This is a short and cute question. Let's finish it fast. So what he says is that PQ Limited sells bottles and currently is trying to find out the profitability of opening another store which will have the following expenses and revenues, he says. Okay, so he has given the selling price and variable cost and some fixed costs. So what he wants is that annual BEP, annual break even point in units and also in value, and also determine the profit and or loss if 35,000 units of bottles are sold. So if 35,000 bottles are sold, what is the profit or loss he wants? And also with the above information of sales, you know, the sales, variable cost and fixed cost, using that information calculate the annual BEP in units and in value, it seems. Isn't it simple, guys? So the question explanation is completed. Now let's quickly understand the answer part. So what he have asked, firstly annual BEP in units and value, right? So firstly, tell me what is the formula for annual BEP, that is break even point. What's the formula for break even point? Sorry, I mean, yeah, total fixed cost by contribution per unit is itself the formula for break even point, right? So, if we insert the total fixed cost and contribution per unit, we get break even point or not? Yes. So, what is the total fixed cost and what is the contribution per unit? So, first let's see what is the total fixed cost. Here he has given in the question, all some, you know, some kind of fixed expenses, that is rent, office and administrative expenses, advertising and other fixed expenses. So if we add all these like 6 lakh, 20 lakhs, 26 lakhs plus 8, so and 2, so total comes to 8 plus 2, 10 and 20, and so 36. So 6 lakhs plus 20 lakh plus 8 lakh plus 2 lakh, total comes to 36 lakhs, which is total fixed expenditure. And contribution per unit we require, no? So here he has given selling price as 600 and variable cost, that is material cost and salesman's commission for 410 plus 60, which comes to 470. So if we deduct selling price minus variable cost, that is 130 per unit, which is contribution per unit, right? So here he have done the same. Contribution per unit, 600 is sales, 470 is variable cost, total variable cost. So minus, if we deduct both, we get 130 rupees per unit. So that is contribution per unit, right? So we are going to insert the total fixed cost and contribution per unit in this formula, so that we are going to arrive at break even point. So 36 lakhs is the total fixed cost. Let me zoom it. Yeah. So 36 lakhs is the total fixed cost and contribution per unit is 130. So that we arrive at 27,692. Units can't be in decimals or portions, right? So you can approximately take 27,693 units. So he have asked in units and also in value. Don't forget that, guys, because only half of the marks you get, okay? All you have to do is just one step, also you will get half of the marks only, because he asked in units and in value also. So in value, how you do it? So break even sales, what's the formula for in units? In units there is a different formula, in value there is a different formula, but there is not much difference there, just the denominator changes. So same formula for break even sales in value also, but the denominator changes. What is the formula? Total fixed cost divided by PYB ratio, that is profit volume ratio. You know profit volume ratio, contribution by sales into 100. So total fixed cost is 36 lakhs, and PYB ratio we are going to calculate it here. PYB ratio, profit volume ratio, contribution by sales into 100. We have we don't have a total contribution or total sales, no, we have contribution per unit and a selling price per unit. So 130 rupees, as we have done before. Okay, and selling price is 600, so into 100 we are going to get this percentage, which is PYB ratio. We are going to insert it here. So 36 lakh divided by 21.67 percentage, which comes to 1 crore 66 lakh 12,829 rupees. This is in value. So BEP, break even point, annual break even point in value and in units. First required is over, no? Yeah. Next, what he is asking, also determine the profit or loss if 35,000 units of bottle are sold. So what is the units here? How many number of units he want? 35,000 units. So what is the formula? Simple formula for profit, you tell me. Contribution minus fixed cost, you get the profit, right? So what is the total contribution? We don't have total contribution, ma'am. We have a contribution per unit, per unit, no. So per unit, what is the contribution? 130. How many units? 35,000 units. That only we are going to do. So total contribution is 130 per unit into 35,000 units. Why 35,000 units? Because he asked. So 35,000 units into 130, which comes to 45 lakh 50,000. And what is the fixed cost? 36 lakh. We have calculated above, no. So total fixed cost, which is 36 lakh. If we are going to deduct this fixed cost from total contribution, we get the profit of 9 lakh 50,000 if we sold 35,000 units of bottles. Okay, the second required is also completed. Right, we have done. Okay, so question number 4, BBit also completed, guys. If you have any doubts, let me know in the comment section. Thank you.